Welcome back to Morning Trade Live. We're preparing for a very neutral open right now. Futures mixed around a bunch. Got some earnings up, some down, but generally it has been up. S&P's at 5,000. Let's bring in Ann Sonders, Chief Investment Strategist at Schwab Center for Financial Research. Morning, Ann.
Morning, Oliver.
We've got big 5,000 on the S&P. Tell me about earnings, because it seems like that is the latest leg of this rally.
It is, and we've gotten a rash of some of the mega cap reports, which for the most part have been good, and that helped to boost what they call the blended estimate, which is the combination of companies that have already reported with those that have not yet reported. It's kind of bouncing between 7 and 8%, which is much better than the low single-digit percent a couple of weeks ago. But it is still the case that although their earnings beat rate is strong at about 82%, the revenue beat rate is 20 percentage points less than that at only 62%. And the percent by which top line has beaten, which is I think is 6 or 7%, is significantly better than the percent by which top line has beaten, which is only about 1%. So they're, bringing into focus profit margins and that differential between top line and bottom line.
Wow, so it really is the year of efficiency, as it seems like the priority. Companies that get this message being rewarded, companies that don't get the message being panned, essentially.
Yep. Especially the double beats relative to the double misses, meaning, companies that beat on both top line and bottom line get rewarded versus the companies that miss on both getting pretty hammered. So you are seeing divergences in terms of behavior around earnings releases at the individual company level.
This is one thing I kind of struggle with a little bit in terms of explaining kind of the market and describing it from a narrative perspective. As we know, there's so much concentration, and in many ways that kind of looks like a weaker market. But at the same time, there's a lot of dispersion too, which seems like kind of a healthy thing. What do you think, Ann? How do we marry those two concepts?
So we are seeing more dispersion even among groups like the Magnificent Seven.
Exactly.
You still have a mega cap bias, and you have it outside of just the Mag 7, because that, even those 7 stocks are no longer the largest 7 stocks. Tesla dropped down to the number 10 spot, which means 3 stocks leapfrogged Tesla. So it may be the case that we have to rethink or constantly have different names in that group. But if you go across all sectors, all indexes, you see that large cap bias. It's just not as dominated by that very small handful of names. So you have divergences within segments like the Magnificent Seven, but that large cap leadership is still dominant wherever you look. And that's one of the reasons why you continue to have this underperformance between equal weight and cap weight. But it's no longer those 7 specific names that are dominating performance. In fact, as of a couple of days ago, and I haven't looked at the ranking, you still had NVIDIA at the number 1 spot year to date, but you had Tesla at the number 502 spot year to date. And so, by the way, that provides opportunities for stock pickers, but clearly you still have to have that larger capitalization bias.
Yeah, the Tesla example is a great one because it's in this category, but has broken off in a big way. So even kind of within the most popular, strongest sector cohort, if you will, as there's a ranking. There's a very clear pecking order. So when we think about that going forward, does that just kind of give us some idea on how to define quality in this market, Ann?
Well, we've talked about this so much, Oliver. I think particularly if you are moving down the cap spectrum where there are opportunities, you absolutely want to stay up in quality. I don't think we're at that point in the cycle where you can start to look for a significant turn back up in the economy such that you do want to move down the quality spectrum. That's where the leverage is in terms of kind of the swing in earnings and going from not profitable to profitable. I don't think we're quite there yet. But I do think that there are opportunities if you stay up in quality, which is why we always say if you're going to use an index as a base from which to start looking for stocks down the cap spectrum, the S&P 600 is a higher quality index than the Russell 2000, which still has a pretty large percentage of zombie companies. But I think we're still in a distribution phase here. What's interesting is, the NASDAQ and S&P are not far from, in the case of the S&P, it's at an all-time high. But in the case of the NASDAQ, the average member maximum drawdown from a year-to-date high, we're only in February here, is negative 19%. And it's about negative 15% for the Russell. It's healthier for the S&P, but even within an index that is propped up by these mega caps like the Nasdaq, there is more weakness happening under the surface, and I think we need to stay focused on what's going on under the surface.
Very interesting. Right now, the top line, the stuff on the surface, doesn't seem to be bothered by what we've gotten in the interest rate market, what we've heard from the Fed. To kind of shift over to the macro here, Lizanne, is we're pretty much done with data for the week, but we did get a lot of Fed speak, and then we'll get some inflation prints pretty soon. But the bottom line has been, March cut odds are pretty sticky below 20% now. It seems like we finally turned the corner on that subject. I guess it's okay as far as the market's concerned.
Yeah, and we haven't had a lot of Fed speak this week, and even some Fed speakers that would be considered on the more dovish end of the spectrum still seem to be expressing their views around patience and the idea that the long and variable lag suggests that staying in pause mode a bit longer probably makes sense. In terms of the reaction function of markets and indexes to whether it's probabilities around, is it March, is it May, is it June, or moves in yields, that seems to be a bit more acute in indexes like the Russell 2000, less so for, say, an index like the S&P, where last year the S&P and the Nasdaq were directly and inversely correlated to what was happening with bond yields. That seems to have broken down a little bit, but that connection still exists down the cap spectrum.
For sure, and something that we've talked about. I know you wrote about this. I wrote about it. I mean, it's so, I think, good that we got some big examples of days where good was good, bad was bad. I mean, last week basically are two big days, but that's so far that's basically it. But we kind of stretch back the correlation. It starts to look like it's building a little bit here the last month.
Yeah, and I think next week should be a very interesting week in terms of expectations around Fed policy and what we might hear from any Fed speakers, because of course we've got CPI and PPI both coming out. We don't need to share why that's important. It obviously is, but there's also retail sales and industrial production coming out. We've got some key housing related indicators, the NAHB Housing Market Index. We've got building permits and starts, which are leading indicators. We've also got the NFIB data that comes out for small business sentiment, and the component questions I think are always as interesting as the headline. And then you've also got University of Michigan, which is not just about consumer sentiment, but also inflation expectations, which has been something that the Fed has focused on. So I think next week is a very important week for a data-dependent Fed.
Okay. Wanted to hit a couple charts real fast just to put some visuals on the bond stock relationship. From your latest note, you look at the rolling 1-year correlation. We can see that's been dipping after being elevated for much of the last year. So that's kind of what we were talking about with the correlations. As far as the overall market performance around the kind of end of the Fed hike cycle, the one we had up a moment ago, I just wanted to revisit because we're pretty uniquely positive and bullish right now, Lizanne. It seems like, it's a good thing that the hikes are done, but like even by historical standards, you've taken a pretty good sample of 14 of the last ending rate hikes. And it usually doesn't go this like euphorically.
Well, so the turquoise line represents the current path, and that vertical line is the point at which the Fed gave the final hike. And there are only 14 prior cycles. The problem is that average, which is the darker blue line. And Oliver, I don't know if you have the other chart that was in the report, but it shows the historical ranges around that average, which are massive. They're massive not only in terms of S&P performance, whether it's periods following the final hike, whether it's during the pause period, whether it's once the Fed starts cutting, what has happened. The ranges are wide. And when you only have 14 prior cycles and you have an incredibly wide range, 14 cycles is not a large sample size, especially when you've got such a wide range, which brings up the old adage of analysis of an average can lead to average analysis. What's key here with the turquoise line is that post vertical line, that sort of 3+ month point, that represented the peak in bond yields. So it had less to do specifically what the Fed is doing, but what is happening in the bond market, in part as a function to anticipate what the Fed is going to do. I think, on the prior chart you showed, and you don't need to bring it back up, is that rolling correlation, which has recently been negative between bond yields and stock prices. Now we're kind of right at the flat line. And I think that highlights that bond yield moves are now not just about the move up and down, but the why behind moves up and down. I think if yields are moving up because growth is improving without attendant concern by inflation, that's a great short-term backdrop for the equity market. Of course, yields moving up because inflation is rearing its ugly head, again, would be a much more negative backdrop. So now we're at the point of not just the move itself, but the why behind moves in yields that I think will be short-term drivers of what equities do.
Sounds like the market's getting a little bit smarter, a little wiser, a little more discerning. You combine that with the dispersion within sectors and styles, and maybe we are kind of getting to a little bit more of a mature, sophisticated
Let's
market.
hope.
All right, good, great stuff, Lizanne. Like those last two
Oliver.
charts in particular, really good perspective for us. Lizanne's Chief Investment Strategist at Schwab Center for Financial Research.